So welcome back, everyone. This is week 3. We're looking at accrual accounting and adjusting entries. We've actually been doing a fair bit of accrual accounting because all accrual accounting is not having Ishtiaq record a revenue when I give him the money. It's Ishtiaq recording revenue when he performs the work. That's accrual accounting. So to an extent, we've actually been doing this already. The thing which is the real add-on is the adjusting entries. That's something that which we haven't done. So if I just take you back to where is it? What we talked about at the start of today. This is what we've been doing. We've taken economic transactions which have taken place, we've put them into a journal. That's what we did just then. We then put them into a ledger, which you guys did to the most part just then as well. We then created a trial balance, which is where we ended up at a few minutes ago. What we're then going to do is to make a few adjustments to that, because the journal entries we make happen based on economic transactions which take place. Now, there are things which don't have specific transactions which occur, which we still need to build into the statements. And we'll look at what those particular things are in a moment. So where we're going specifically is describe how profit is measured and reported under the accrual and cash base of accounting, which we all pretty much know at this point. Identify the 4 major circumstances in which adjusting journal entries are necessary. And adjusting journal entries become necessary primarily because there is a separation between when money changes and when revenue is earned or expenses are incurred. Those are the two things which really drive that. So if money changed hands and the event occurred and the revenue was earned at the same time, then that doesn't really cause as much of a problem. But because there is a separation, and there are some really common separations, which we'll talk about, that's why we have adjusting entries. We record and post adjusting journal entries and prepare an adjusted trial balance and financial statements. That's the big part of what we're going to be doing today. Describe the purpose of the closing process and prepare closing entries. So there's one bit right at the end. So we've got the adjusting entries, we create the financial statements, and then there's a final little bit that we have to do, which is really important. And it's very easy to do, but we need to do it, and we'll see why that's important right at the end of today. So where we got to was, stuff happens, we put it into a journal. We take this, we prepare a trial balance. That's what we've been doing, that's what we're up to. We then have to do these adjusting entries and create an adjusted trial balance. That's what we're going to focus on today. We then prepare the financial statements. Going from a trial balance to the financial statements, going from an adjusted trial balance to the financial statements is the same thing. It's just slightly different numbers. So the process in that bit is the same, and that bit we're comfortable with. The final bit is to get these closing entries, why we do them and what they actually are. So that's where we're going. We're not specifically going to do the closing trial balance, but I mean, that is an important part of it as well. So we did 1 and 2 last class, and we're going to do the rest today. So accrual versus cash accounting. The difference between the two approaches is the timing of when we record revenues and expenses. So if Ishtiaq is working under a cash-based system, and if he's a small trader, you actually would be using a cash system. So if he Ishtiaq as the individual, most of us as individuals, I don't use for my record keeping about what I spend money on and do and earn and whatnot. I don't use accrual accounting. I mean, that would be overkill for an individual to do that. I use cash-based systems. I figure out how much money I get in from when I get paid. I figure out how much money I pay out on my credit card bills and stuff. I'm not using accruals. So for individuals, for small businesses, they use cash systems because it's cheaper to do, it's easier to do. So when I give you the money, you've earned money. That's it. Under the accrual system, sorry, there's cash received, expenses paid. Under the cash system, sorry, the accrual system, that's not quite right. We record revenues when they are earned, so when you go and get whatever I've asked you to get, or we record expenses when they are incurred. Now, last year, driving somebody else's car, who shall remain nameless, I got done for driving an unregistered vehicle because it had been out of rego by 2 days, which is a relatively hefty fine. Registration is a yearly thing. You can pay it sort of incrementally, but let's say it's a yearly thing. So for an individual, think about this under the cash or accrual basis. As an expense under a cash-based system, if you're paying $600, that works, $600 for rego for a year, and let's say I pay that on March the 15th, I would, under the cash-based system, that would be a $600 expense in March. So if we were to have the year drawn out, January, February, March, April, May, June, July, August, and so on, for this, and let's forget this has happened, I would show a $600 expense in March, and then I would show 0 expense in April, because I didn't pay anything in April. I'd show 0 in May, I'd show 0 in June, 0 in July, 0 in August, 0 all the rest of the year. Am I using that registration in April? I am. I've paid a 12-month registration. Am I using that registration in May? I am. In June, in July. I'm using this registration across those years. A cash basis doesn't pick that up. It just shows you've got a $600 expense in March. That's it. Under the accrual system, we record the revenues when they are earned and record expenses as they incurred. The expense for my registration across 12 months, if I was to do my accounting, my personal accounting under the accrual system, and which I will stress, even though I'm an accountant, I don't. I just do it as a cash-based system. I wouldn't show 600. I would show 50. Because actually, March the 15th, I'd show 25, which is half a month. Then I would show 50, and I would show 50, and I'd show 50, which is 1/12. I'm pretty sure 600 divided by 12 is 50. So I'd show 1/12 of that each year, each month, to reflect that I've used 1/12 of it. That's the idea behind it. So it's not the fact of when the cash moves, it's about what you've used up over that period of time. That's the key difference. And it's a better reflection of how you've actually used something. So that's a big difference between cash and accrual accounting. Now, accrual accounting, for-profit businesses, not-for-profit businesses, government organizations, many organizations use accrual accounting. Generally, very small organizations won't, but outside of that, it doesn't matter if you're for-profit or not-for-profit, you'll use accrual accounting. So identify the 4 major circumstances in which adjusting journal entries are necessary. Accounting doesn't record transactions as they happen, it records them when something significant occurs. This means at the end of the periods, records need to be brought up to date. And we'll go through an example with you right now. So this is actually an example of it, but let's use something different. I work. It's what I'm supposedly doing right now. I like to think I am. I hope you guys think I am. It would be good if you did. I don't get paid on a daily basis. I don't finish up at 5 o'clock today and then go up to the office and they give me out money for the day and then I come back the next day and they pay me. They pay me on a fortnightly basis. Most workplaces in Australia is a fortnightly basis. Some is a month. I know in the UK it's a monthly system. Well, at least some organisations over there. So let's just say $1,000 a week and get paid fortnightly. Payday for me was yesterday, so it was a happy day. For the university, it would be debit, salary expense, $2,000. $1,000 a week for 2 weeks, $2,000. Credit cash, $2,000. So this is payday. This is the significant event which has happened. They don't record an expense for me every day. They don't record an expense for me every hour. They could if they wanted to, but sort of what's the point? So they just record it when I get paid. And then 2 weeks later, I'll make this a bit brighter, make this a bit wider. 2 weeks later, it'll be debit salary expense, credit cash, $2,000. And it's another payday. Those would just be like what we were doing earlier today. Something happens, we see employees get paid, debit salary expense, credit cash, that's easy. No one should be uncomfortable with that. And if all of this is within an accounting period, so this is the start of the period, and this is the end. That's easy. It all happens in the period. We see it being recorded. We recognize that I've worked for 2 weeks in that period, and that would be reflected in the journal entries that happen. That's all okay. Where it becomes an issue is if the financial year end or the period end, whatever we're looking at, cuts that pay period. Then we've got an issue. Then this is a classic adjusting entry situation. I got paid at this point, or employees got paid at this point. This period of time is 1 week. So at the financial year end, we're at this point in time now. Have I done work for a week? I've been paid. Have I worked between when I last got paid and the financial year end? Yeah, I've worked. Come to class, I've done the things that I need to do. I've worked. If we don't do any entry, is the university recognizing in their books the fact that I've done work? No. Because the last entry they had in relation to me was the one at this point in time. That's the last thing that they had recorded. So it's kind of like I've worked for a week, and if they don't do anything about it, they miss out on the fact that I've done $1,000 worth of work for them. But also at this point in time, what else do they need to recognize at the financial year end? I've done some work for them. What haven't they done for me by the financial year end? They haven't paid me for that week. Do they owe me for that week? They do. Do they owe me for this week? No, because I haven't done the work for this week. So they don't recognize the $1,000 for this week because I haven't done anything for that. But I've done the work for this week. They owe me $1,000 for this week. So at this point in time of the financial year end, they need to tweak or make an adjustment to their financial statements to reflect that I've done 1 week's worth of work for them and they owe me 1 week's worth of work. That's the adjustment that will take place. So the adjustment would be debit salary expense, $1,000, credit salary payable, $1,000. That reflects that they owe me for that. That's the adjusting entry that would take place. So this is a really classic situation because They have incurred, so think about expense recognition. They have incurred an expense. They haven't paid for it yet, but it has happened. We need to make sure that that gets recorded. So the adjusting journal entries. Adjusting journal entries are made to record revenues and expenses that have been earned or incurred but not yet recorded. Recording and posting adjusting entries is the third step in the accounting cycle and occurs at the end of each accounting period after the trial balance is prepared. There are four main types. And if we want to think about them, so we've got 2 points in time, T0, Tn. So the first type we get paid up front for something and then we earn it. Type 2 is we earn something and then we are paid for it. If we earn and are paid at exactly the same point in time, this is not an issue. The issue exists because payment and earning get separated out at times. So these are obviously for revenues. On the expense side of things, we pay for something and then we use it. That's pretty much what was going on with my car registration. I pay for it for 12 months up front and then I will use it sequentially over time. And 4, I use something or the company uses something and then they pay for it, which is exactly this situation. They've used my services and then they will pay me. That's what happens to salary. We get paid after the fact. We don't get paid salary up front to do work for the next 2 weeks. We get paid after we perform the service. So that's what's going on over there. So when a company receives cash, so the first one, when a company receives cash before it provides a service, it has deferred revenue or unearned revenue. The adjusting entry at the end of the accounting period needs to record the part of the revenue that has been earned. So we should probably change, how many of you guys buy magazines? People do. Although, maybe they're online versions. I don't know how many people subscribe to magazines anymore, but if you think about a lot of other services, if you think about, for those in sort of the creative space, Adobe Creative Cloud is, a subscription service. If you're looking at Dropbox is a subscription service. If you want to pay extra for Apple Cloud services, that's a yearly subscription. A lot of these things may be yearly subscriptions that you pay for something up front. So from the company's point of view, you are paying them to provide you service over the next 12 months. After a month, straight away, they don't get to show revenue. They show revenue as it occurs. So they received $1,200 for those 20 subscriptions for a month, for 12 months. That's what would happen initially. You'd debit cash, $1,200, credit unearned subscription revenue. Unearned subscription revenue is a liability, and that reflects your obligation to provide those magazines. We talked about airlines having unearned service revenue. Because airlines, that's their model, is that you pay for your flights and then you fly. Especially those that are going off and doing accounting, if you haven't done so already, I would highly recommend that you do so. Go and download Qantas's annual report, whatever annual report, the latest one 5 years ago, doesn't really matter. Download their annual report and look at their balance sheet. One of the biggest liabilities they have is unearned revenue. That's because that is the business model of an airline. So assets go up by 1,200, liabilities up by 1,200. What's really important here, equity hasn't moved. When you're paying for that subscription, when they receive that subscription revenue, they haven't provided anything yet. There is no revenue effect at that point. Cash, unearned subscription revenue, nothing to revenue. When a month later they draw off their accounts, they've performed 1 month, assuming they have shipped out those magazines or provided them. You have an adjusting entry for that revenue, unearned subscription revenue, debit that 100, so the liability comes down because they've partly satisfied it, and you credit subscription revenue to reflect that they've actually done some work now. So record revenue for that. So liabilities go down, equity goes up. That's the point in time where they get to show that they've earned revenue, when they've actually done something. Debit cash, sorry, not cash at this point. So cash has already been debited. Unearned subscription revenue gets debited. Subscription revenue gets credited. Okay, so that's ticking off the first one. Accrued revenue, where you earn revenue before you receive cash for it. So if this was with Ishtiaq, if I said, if you go down and buy me lunch, I will then give you some money, and you perform the job, and then I pay you, and the financial year end for you splits between when you do it and when I give you the money. That's what we're dealing with here. When a company earns before it receives it. So the adjusting entry needs to record that revenue. So an accounting firm provides services to a client for $1,000, completing its work on the 23rd of September. They bill the client on the 10th of October and receive payment on the 21st of October. The accounting firm closes its own books on the 30th of September. Now, I don't know if you're like me, but I really struggle when I just read stuff like that to try to mentally map out when things happen. I need timelines to help me with this. So you can see it in here. So we've got the 23rd of September, the 30th of September, the 10th of October, 21st of October. So paid, completed work, financial year end, bill sent. Okay. Now, ignoring the fact that this is an accounting firm who you think you should be on the ball, that they've completed the work over here on the 23rd and then waited nearly 3 weeks to send the bill out, to me that sounds a bit funny. By the by though, they did the work here, the financial year ends, they wouldn't have recorded a transaction until the bill got sent out. But they have done the work in this year. So we need to show that they've done the work in this year because at the moment there is no transaction reflecting that. So the adjusting entry, and all we need to do is the adjusting entry, there's no original entry for it, is debit account receivable, 1,000, and credit service revenue, 1,000, to pick up that they have done the work as part of this year. Even though, because at this point in time, they wouldn't show anything up. So by showing the service revenue, they are picking up that they have done work and equity goes up and assets go up. So debit account receivable, credit service revenue. What I've hoped you've also noticed is in both of these situations, this one and the previous one, bless you, cash hasn't been touched. And we'll see later, cash will never be adjusted in an adjusting entry. It's just not something that can ever happen because if you have cash being involved, it's an actual transaction and then you don't need the adjustment for it. Prepaid or deferred expense. This is my car registration. Tell you what, and police cars nowadays have automatic automatic number plate recognition technology. That's how we got picked up. They were just driving the other way and it automatically just scanned our number plate. He's done, we were out in the country, he did a UE, came back after us. I was doing the speed limit. I was quite shocked when I found out what was going on. Anyway, when a company pays for a resource before it uses or consumes it, insurance. Do you ever buy insurance after you need it? Yeah, it's a bit late by that point. Sort of defeats the purpose of insurance. Insurance is you buy it before you need it, in case you need it. That's the whole point of it. So we debit, or so we don't debit something. We have insurance and we buy it up front. Most of you guys would probably be, many of you guys, I'm renting as well, many of you guys are probably renting. Think about how your rental agreement works. Do you pay your rent up front, or do you pay it 2 weeks in advance, or do you pay it 2 weeks in arrears? In advance. So you're prepaying something for use later on. That's a prepaid expense or deferred expense. So when you pay for something before you use it or consume it, you've got a deferred or prepaid expense. So on the 1st of March, a company purchased a 12-month general liability insurance policy for $36,000. We debit prepaid insurance, and that prepaid, anything prepaid is an asset. Prepaid insurance, prepaid rent, prepaid registration. Prepaid insurance is an asset, so that's an asset of $36,000 and cash out of $36,000. So the original transaction is no net effect on the balance sheet. It's just assets up, assets down. The company prepares financial statements 1 month later. The company has consumed 1 month of that insurance, so $3,000. So we need to reflect that we've used up $3,000. So we're picking up an insurance expense of $3,000, and we're reducing the prepaid because think of the prepaid as this sort of pile of insurance that we have available to us, and we're just slowly working our way down the pile. So the asset of prepaid insurance is dropping, and we're reflecting the expense as we use it. So the prepaid insurance is reduced by $3,000 with a credit, and the insurance expense is increased by $3,000 with a debit. And the last one that we have is that one, accrued expenses. Something where they've used it up front and they pay it later. So the adjusting entry at the end of the accounting period needs to record the expense that has been used or consumed, but not yet paid. Look, different numbers here. Different numbers than what I had over there, but it's the same idea. People have worked, they haven't yet been paid at the end of the financial year. In this case, it's 5 days. 5 days of $1,000 is they are owed $5,000. So salaries expense, salaries payable, except some different numbers. But the idea is very much the same. Cash doesn't get affected here, but salaries payable is increased by 5,000. Salaries payable is up by 5. Salaries expense is up by 5. All right, 2 important things to remember with this. The second one is one which you should I mean, the first one I can understand, kind of you can get mixed up with, but the second one is just something you should just absolutely know. So the first one is there'll be, in any transaction and adjusting entry, there'll be one effect, at least one effect on the statement of financial position, so an asset or liability, and at least one effect on the statement of financial performance and a revenue or expense. That has to be. The second is, and we see it, and it's frustrating when we see it, cash is never involved in an adjusting entry. Because if cash is involved, you have an actual transaction. And that would have been already dealt with. So never try to put cash in an adjusting entry. And on that note, we're going to have a look at a comprehensive example of doing some of this. So the first thing I want to have a look at is this trial balance here. What I've given you is the same as what's up there. So it's the same as what's in the slides. That's what we've got. This is based off the information from last week. So it keeps flowing on from the original example. What we're going to do with that, and I will put up this file later on, is we are going to update this file. And this file, as you can see here, we've got 3 sets of columns. We've got the unadjusted trial balance, which is exactly the first sheet, except I've added in a few spaces because we're going to have to put in some more accounts in there. But same numbers, same total balance. We've got a pair of columns for the adjustments that are going to be made. So these are the adjustments that we're going to do going through the example. And lastly, we've got the adjusted trial balance. This is the trial balance after we have made those adjustments that need to be done. So we're going to work through this together, but obviously, sort of coming into the weeks to come, you're going to have to be able to do this. So it's very much a good idea to play along. So the first entry we're going to have, so we're going to go through this and then I will make the adjustment to the file. So the first thing that happened is, this is an original transaction. This is from last week. They received $2,000 to do something in the future. So they can't show any revenue at that point in time. They've got to show unearned revenue. That's where that came from. And 2,000 of this came from that transaction. The adjustment is on the 31st of May, Circle Films filmed the retirement reception, so they've actually now done the work and received the money. Sorry, say again. They filmed the work, so they've done it, they've earned the revenue. They received the money back earlier on. So what happens is the unearned revenue gets reduced, and we get to show service revenue. So liabilities go down because our obligation has been extinguished, and equity goes up because we've got revenue. You can see that unearned ends up at 0. Service revenue, its carrying total at this point in time is $7,000. So what I'll do with this is actually what I'm going to do is I'm going to add in, and I will make this file available later on. So I'm going to make a running total. These. And equals that plus that minus that. Okay, so what I've just done then is set up the formula so that this will automatically track through. Again, I'll make it available with the formula so you can see how that works when you need to. But first things first, as you're doing these adjustments, please put them into this over here. But what you can see is this balances, and we won't be touching this. The adjustments currently balance because we've got no adjustments in them, and the adjusted trial balance balances because we made no changes. So unearned revenue is debited $2,000 because the liability has been extinguished. So we debit that $2,000. And we get to show service revenue, so we credit service revenue $2,000. I'll make this a slightly different color. All right, so debit unearned revenue, credit service revenue, everything balances in the adjustments column, and everything still balances over here. So we're okay at that point. Adjustment 2, accrued revenue. Circle filmed the first night of a 2-night play. The second night will be filmed on the 1st of June, which is later on, after which the customer will be billed. So in May, they have done 1 night of work, but they haven't sent the bill out, so they haven't actually recorded any transaction for it. So we need to debit account receivable, $1,500. So even though they haven't billed that client yet, they still need to show that there is money owing to them. And they need to show revenue because, importantly, they've done the work. That has taken place. So what I might do, So assets go up by $1,500 because we've got an account receivable, and equity goes up by $1,500 because we've earned revenue. Account receivable increases and service revenue increases. So I'll come back to this. Now, account receivable didn't exist, so we're going to have to add it in, which is why I left a blank space. I'll leave that there just for the sake of it, and we increase that by $1,500, so debit $1,500, and service revenue, we have to add an extra $1,500 here. So we credit $1,500, well, not another $1,500, where we credit an additional $1,500 to service revenue. And again, everything still balances in the adjustments, and everything still balances in the adjusted trial balance. The third adjustment is deferred expense. After a physical count, they determined they had 650 of supplies remaining. They reported they purchased 1,000. And you can kind of see that here. They've got supplies of 1,000. If you do the stock take, you know you've got 650 here. You know then what the adjustment has to be, because we've got to go from 1,000 debit down to 650 debit, which means it's a 350 credit to supplies. So that's what's got to happen. So debit supplies expense, because we've used up 350 of supplies. We credit supplies themselves, 350. Assets drop, equity drops with the expense. And we end up with 650 of supplies and 350 of supplies expense. So supplies, we credit 350 to bring it down to 650. Supplies expense is a new one, so we add it in. Started with nothing, and we debit supplies expense 350. And again, everything is still balancing, 3850, 3850, 32.5, 32.5. So we're still looking good on that front. All right, second last one. The last one, there is a point we're going through all this. One, we've got to do the adjustments, but secondly, especially with the last one, we start to get a glimpse as to where people talk about creative accounting. The fifth adjustment, that's where we start to see how this can happen. Adjustment 4, accrued expense. The interest rate for the promissory note is 6% per annum. So for $9,000 borrowed at 6% over 12 months gives you $45 a month. You record an interest expense of $45 and an interest payable of $45. Liabilities up, equity down. Interest payable of $45, interest expense of $45. We can see how that flows in. So back to the spreadsheet. So interest payable, because we owe it, wasn't in there before. We credit that, 45. And interest expense, 45. Everything's still balancing. Everything's still balancing. Keeping everything nice. There's one last adjustment that needs to be made. There are 2 gaps here and here. That's what we're going to deal with. Circle Films estimates that depreciation for May on its 2 cameras totals $600. We haven't really touched depreciation before, not a huge amount of detail. So there's a couple of things I want to talk about this once we put the entries in. So we debit depreciation expense $600, we credit accumulated depreciation $600. Assets go down by $600, equity goes down by $600. Equipment, depreciation expense is debited, accumulated depreciation is credited. So accumulated depreciation is a credit of $600, and depreciation expense is a debit of $600. The adjustments 4495 in total, they all balance. The adjusted column is 33145. They balance, and we're looking good. Now, a comment about depreciation. Because now we've finished everything. If we go back to this idea of we've done all this, that happened last week. We've just done the adjusting entry. So now we have an adjusted trial balance, and we can put it into the financial statements. So That information there is now what we put into the financial statements. But before we do that, I want to talk about depreciation. Accumulated depreciation first. Accumulated depreciation is not a liability. Even though it has a credit balance, it's not a liability. You will actually find it in the asset section. It's not an asset either, by the way. Accumulated depreciation as an account is what's called a contra account. It doesn't exist on its own in the wild. It has to be with something. It goes with a non-current asset. It goes with equipment. It goes with buildings. It goes with some sort of non-current asset. Other than land, that's a different story. So equipment is 18,000, so the 2 cameras, and we've got accumulated depreciation, and you would show in the financial statements, you'd show the net amount of those two numbers. Depreciation, now talking about what the number represents. More importantly, what the number doesn't represent. When you hear about depreciation, if you were to hear the word depreciation in sort of usual usage, what thing do you usually associate it with? Are there things that you associate depreciation with? What's that? Investments. Investments sometimes depreciate in value. What else? What are other things that we potentially get that depreciate? Equipment depreciates. Vehicles. That's probably the big one that we're most common. Yeah, we're most commonly, I would say, vehicles and cars, bikes, whatever, probably the things we're most used to thinking about depreciating in value. Investments depreciate in value. Once you drive a new car off the lot, generally they talk about it losing 25 to 30% of its value, pretty much like that. That is not accounting depreciation. That is dealing with a change in value. So investments changing in value is a value change. That's a different thing. What accounting depreciation is just spreading out the cost of the asset. So that $18,000 in camera equipment, when we bought it, we debit asset, we credit cash, or we credit liability, we credit something, but we don't credit a profit and loss thing. That means if we haven't reflected an expense for that asset, depreciation is the expense. So all that we're doing is over the life of this thing, we're running it down to some number. It could be 0, it could be whatever, we'll talk about this in more detail next week. It could be whatever we think we're going to get for it at the end of its useful life. All that depreciation is doing is allocating that $18,000 out into little bits over the life of the asset. It's not a market value effect. So what they're saying here is if you run the numbers really quickly, assuming they've had them for a year, actually no, for a month, they're saying, so I think this is for a month, they're saying those cameras will last for 30 months. They're saying the useful life of those cameras is 5 years because they're allocating $600 out per month on depreciation. Now, why is this important? So if you remember these numbers, if you've written them in, if you've done them, because we use these numbers to do this. We've just taken the revenues and expense part of that. The revenues were $8,500. The expenses totaled $3,245, giving us a net profit of $5,255. Now, one of the adjustments we had was, where's one? Let's look at, say, interest expense. Actually, no, let's look at supplies, top one. Supplies of $350. How did we work out we had $350, like in real terms? How did we work out, or this company work out, they used up $350 of supplies? Yeah, they sold $650, but how did they figure out they used $650? Like, what was the actual process? Think about the real, like, how did they work that number out? They didn't pluck it out of thin air. They did something to come up with $350. What did they do? Maybe refer back to the information in the slides. Louise? No. What did they do? Go back and have a look at what did they say in that adjusting entry information. What was the real thing that happened in the business for them to be able to work this out? It's not meant to be a trick question. It's like, what did they actually do? They counted it. They went through at the end of the month and counted up all their stuff and went, we have $650 worth of stuff left. They counted it. Now, could they have made mistakes in counting it? Maybe. Could they have made mistakes in counting it on purpose? Maybe. Let's just assume they did it properly and there is an absolute truth. If you went through and checked it, if you had an auditor come in and check it and double check it, and they found there was $650 worth of stuff there, you can say with a good degree of certainty that that $350 expense is actually a $350 expense. Hopefully everyone's following me on that. The reason why that's important is, what about that $600? How do we know with certainty that that $600 is actually $600? How did they come up with that number? And I know we're going to talk about it in more detail next week. So this is just your view of it at this point in time. It is an estimate, Louise. Oh, same. It's an educated guess. Think about the things they have to work out to make it an educated guess. I could roughly sort of work it out working backwards. 18,000, we know that's a number we know. Let's say they're running it down to 0 because that's what they think the camera is going to be worth at the end of its useful life. That's an estimate. They may be able to get something for the camera. They may be able to get nothing. But 0 is an estimate. I don't know, do cameras last 5 years? Could they last longer? Well, okay, that's a designed obsolescence. That's a different thing. I don't know, could it be 4 years? Could it be 6 years? Could it be 10 years? I don't know. The point is, there are estimates used. There's not like there's an absolute truth with this. There are estimates in this. Why is this important? What happens if management needed that number to be 5,300, not 5,255? They can't really change the stock expense. That's being what it is. They could just change depreciation to $500. They just change the estimate a little bit. Make that 500. Make that 3,145. Make that 5,355. They have not changed anything real. They've just changed an estimate, which then changes profit, which has effects.
Another example is the ATA changing depreciation like they change.
They do. They change useful life. They can change things with that. Now, accounting depreciation and tax depreciation are two slightly different things. But you look at companies, they will from time to time change the useful life on things. Qantas about 5 years ago did that. It dramatically changed their profit. But unless you went into the notes to read it, you don't know that that's happened. So you need to be aware of this stuff. So when people say they don't believe accounting numbers, that's why. Is it still better than just doing it on a cash basis? Absolutely. But you need to be aware of where things can start to move around.
Or there's the opposite in the case of OneTel, where the accounting statements were true, but nobody believed them because they had to turn them around and say, no, a loss instead of a profit.
Yeah. Well, I mean, well, that's why you have auditors' reports saying you can read, and if they're doing their job, that's an important thing. But the auditors, if they're doing their job, is saying you can trust these numbers. Hopefully. So retained earnings, we start with 0. We add those profits from the last slide. We take away the dividends that we'd worked out in the trial balance. We end up with retained earnings of 3,755. Finally, we end up with the statement of financial position. If you go back, if you put together the trial balance as well, you'll just see that the cash, account receivable, supplies, equipment, accumulated depreciation, those are the numbers we'd worked out in that adjusted trial balance. Interest payable, notes payable, those are the accounts. If you want to put in unearned service revenue with a zero balance, you can do that as well. Liabilities, the ordinary shares, 15,000 plus retained earnings after all the adjustments. Gives us 3,755, gives us total liabilities and shareholders' equity of 27,800. That's it. That's the statement of financial position. We have one thing left to do. Then we've got a little bit of admin around the quiz. Just want to make some comments about that, and then we'll wrap it up. Closing entries. Describe the purpose of the closing process and prepare closing entries. I need is a little bit forceful. I would like for someone out there who watches sport, plays sport, is interested in sport, a sport. I just need a sport we can talk about, not in a huge amount of detail, just something, anything. Oh, that's a really bad one. So, the horse racing, yeah, sorry. Horse racing is not really a sport, is it? In fact, there's money involved in all of them. Soccer, football. How do you know who wins in a football match? What's that? Ask a bookmaker. You are very cynical.
Well, especially when you're talking about soccer.
Okay.
Money and tennis.
Yeah, and tennis. So how do you tell who's the winner in soccer is? In football? The number of points. Number of goals. So who scores the most goals? What is the score at the start of the game? What's it? 0-0. Why? May seem like a stupid question, but why do we start at 0-0? So it's equal and fair? Because what are we trying to judge across that 90 minutes? Performance. We want to know who performs better. And performance arguably some teams can perform better but not score as many goals. But if you're judging performance purely on goals, the team that scores the most goals has performed the best. So if you start with one team 2-0 as the opening whistle blows, you can't really judge performance properly because it doesn't work. So you start the game at 0-0. They score a number of goals during that game. The next game, that same team will come out. They'll start at 0-0. You start with a clean sheet. That's the point of the closing process. Because when we're judging performance of a firm, how do we judge it? How are we judging performance? The end result, but which statement are we looking at? Not the balance sheet, the other one. The statement of financial performance is probably kind of giving it away a bit. The income statement. We want to know how much profit we make. Profit happens over a period of time and then we strip it down to zero at the end of that period. We don't start with revenues existing. We don't start with expenses existing. We need to clean it all out. So to do that, we close everything down to zero. We close it down, we get rid of all the revenue accounts, we get rid of the dividends, we get rid of the expense accounts. To show that, this is the closing entry. And then we've got a couple of minutes just to talk about the quiz and then we're done. Service revenue, retained earnings. Service revenue has a credit balance, so to get rid of it, we debit it. Expenses have a debit balance. To get rid of them, we credit them and we debit retained earnings. Dividends have a debit balance, so we credit them to get rid of them and we debit retained earnings. This retained earnings, if we add all of this, that gives us the change in retained earnings from the change in retained earnings statement. So to close out the accounts, the main thing is, this is the adjusted trial balance. Assets, liabilities, equity, then all the revenue, expense, and dividend accounts, everything with a balance in here, has to end up at zero. They cannot survive into the next period. We have to start with a clean sheet. We start at 0 and then we start the performance measurement again. And that's closing. The accounting cycle, system of steps, we've talked about that. You close it all off, you start at 0 with the revenues, expenses, and you start doing everything again. It's just a cycle which keeps on going and going and going, which is why the world will always need accountants, because it's a process which never stops. That could be a scary thought. And that's it. That is the whole thing. Now,